It was a tough start to the trading week for NIO, with the stock dropping about 8% on Monday to close at $4.60. And if you're someone who's been following this journey closely, as we have, this kind of move might feel a bit jarring, especially after the more promising momentum we saw building through July. But as we dig into the reasons behind this pullback, a more nuanced picture begins to form. This doesn't look like a breakdown of the long-term narrative. Rather, it's a necessary reset, a healthy pause that long-term investors can understand and even anticipate. The immediate catalyst for Monday's sell-off was NIO's July delivery update. The company reported deliveries of 21,017 vehicles, which was down about 16% from June's record-shattering 21,209 units, though still up 2.5% year-over-year. That kind of mixed signal can shake short-term confidence. It's a reminder that even in the midst of a growth story, not every data point is going to be a perfect step forward. Sometimes, progress looks more like 2 steps forward, 1 step back, and this, we'd argue, is one of those moments. To put things in perspective, June was an unusually strong month. There was a big marketing push, a boost in deliveries of the new ET7 and ES6, and positive sentiment tied to infrastructure expansion and the rollout of the Onvo L60 brand. So to expect a seamless continuation of that performance into July may have been overly optimistic, especially when you consider that the L60 only began shipping in very late July. Those numbers aren't even fully represented yet in the current delivery count, and that's a key detail many traders may have overlooked in their rush to the exit. Zooming out, we also need to look at the competitive environment in China's EV sector. July was a challenging month across the board. BYD, XPeng, Li Auto, they all posted either mixed or declining numbers. The broader EV market is feeling the weight of intense pricing pressure, with BYD and other lower-cost players initiating steep price cuts that are affecting everyone in the segment. So NIO's drop isn't happening in isolation, it's part of a broader cooling in China EV sentiment. That's important to remember because when the market turns down on sector-wide news, it can create short-term noise that doesn't necessarily reflect the fundamentals of any one company. Now let's touch on the technicals, because Monday's action was definitely heavy. The stock sliced through the $4.80 support zone, a level that had served as a short-term floor for the past couple of weeks. Volume spiked, indicating capitulation from weak hands. Momentum indicators like the MACD crossed negative, and the RSI began dipping toward oversold territory. From a chartist point of view, this looks like a flush, the kind of sharp move that can set the stage for a bottom to form. It hurts in the moment, but it often clears the path for healthier price action down the road. So where do we go from here? That's the real question, and here's where we remain optimistic. First, while the delivery data showed a decline, it doesn't alter the long-term thesis. NIO continues to differentiate itself through its battery swap technology, which no other major EV maker has scaled to this extent. As the number of swap stations increases, both in China and potentially overseas, this infrastructure gives NIO a real competitive moat. It solves the charging bottleneck that so many EV customers cite as a pain point. That alone is a reason to stay constructive on this stock. Second, the Onvo L60 is just getting started. Positioned as a lower-cost alternative to NIO's premium lineup, it opens up a much larger addressable market. Deliveries have only just begun, and we haven't seen the impact in the delivery numbers yet. Once we do, it could trigger a meaningful uptick in monthly volumes, especially if the company can maintain its production cadence. This is one of the biggest catalysts on the horizon, and it hasn't been fully priced in. Third, we're moving closer to NIO's Q2 earnings, which will give us updated guidance on margins, cost controls, and capital efficiency. If management can show continued improvement in gross margin, even in a tough pricing environment, it will help restore confidence. And if there's any forward commentary on the timeline to break even, that could be a powerful narrative shift. Finally, we still believe that NIO's current valuation is deeply disconnected from its long-term potential. With the stock trading below $5, the risk-reward profile is compelling. Yes, there are near-term risks, including economic data out of China, trade tensions, and sector-wide competition, but those risks are arguably already reflected in the current price. What's not reflected is the upside from improved delivery figures, expanding infrastructure, and international growth. In terms of positioning, short interest remains elevated, and that creates the potential for a rebound. If sentiment begins to shift, it won't take much to spark a reversal rally, especially with retail investors keeping a close eye on NIO's technical levels. The $4.50 zone could act as a new base, and if volume dries up on further weakness, that might signal that the sellers are exhausted. So here's how I'd frame it. Monday's drop isn't the death of a rally, it's a necessary pause. Stocks don't move in straight lines. Even the best stories get tested. But when the long-term ingredients are still intact, and when investor fatigue begins to give way to opportunity, that's when savvy investors start accumulating, not panicking. We'll be watching closely for signs of stabilization this week. If the stock can consolidate around $4.50 to $4.60 and begin to carve out a bottom, that could set up a fresh move higher, especially if we get any positive news about L60 demand or battery swap expansion. This isn't a time to give up on NIO. If anything, it's a time to zoom out, assess the bigger picture, and recognize that short-term pain can often precede longer-term gains. Stay tuned, the story isn't over, and the next chapter may be closer than it seems.